Results revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off sessions low, still down about 1% on the day for a little more than 4 pennies.
We're scaling our capital in, as opposed to putting all of your capital in at once in an iron condor, which is very commonly done. And so the word tranche can be used for a slice of something. And so it's a slice of capital that is placed onto the trade periodically as you're basically building the trade. So we actually add capital to the trade every 4 weeks, every week on Friday morning. I mean, there's nothing magical about this. It's just the way I trade it. You could develop your own style, but this is just a way of giving you an idea of a way that you can trade iron condors. So that's one distinguishing factor of the trade. And the second distinguishing factor is that we close credit. An iron condor is 2 credit spreads, facing each other, and we'll look at that in a minute. And with this trade, we are going to be rolling any credit spreads that are getting into trouble out of trouble pretty aggressively. We're also going to be closing credit spreads that have shrunk to a very small amount, so that the risk-reward trade-off, is not worth it. And the other thing we're going to show you is a good way to scale out of these things in a way where you can lock your profits in. So there's a lot of different aspects to this, which are a little unusual as far as an iron condor, and there's actually further issues, but I'd rather just jump into the trade example, and then we can discuss all the other intricacies of the trade. So that's the sort of overview. And now what I'd like to do is talk about the basic principles of the trade. We're going to take 4 different iron condors at different strikes over a 3-week period, and we're going to start placing those condors 7 weeks out. The strikes of the shorts in the credit spreads are going to be determined by income we're receiving from those credit spreads, as opposed to deltas, which is typically a way that people manage high-prop condors, through deltas. Thirdly, as we go deeper into the capital placement process, in other words, as we get closer to expiration, we're going to be requiring less income from the credit spreads as we get closer to expiration, because as you get closer to expiration, the same strike is going to yield less income, obviously. So we're going to be coming in a little bit closer, but we're going to try to stay as far as we can from trouble, and the way we're going to do that is by requiring less income. And finally, as I mentioned, the short spreads are very aggressively rolled out of trouble throughout the trade, and we'll show you an example of that.
Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Preivew, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.